Share-based payments. Share-based payments is covered under your PFRS 2, also known as your share-based payments. So this will provide us the accounting for your share-based payments, whether this share base is based mainly on the equity or the issuance of shares of the company, or based on the value of the equity of the company. So later you will learn that your share-based payments can either be based on equity settled, or you will settle it through the equity instrument, or based on the value of the equity instrument, which we know as cash settled. What is a share-based payment? A share-based payment is a transaction in which the entity receives goods or services either as a consideration for its equity instrument. So first, you receive goods or services in consideration of your equity instruments. So you use your equity instruments to pay for your goods or services. What do we know about this? This is your equity settled. Or by incurring liabilities for amounts based on the price of entity's shares. So you receive goods or services and you incur liability that is indexed on the price of your shares. We call this one as your cash settled. So in your share-based payment, generally we have two main categories. That is the receiving of goods or services in lieu of your equity instruments. So in exchange of your equity instruments, you receive goods or services. We call that equity settled. So you use your equity instruments to pay your goods or services. While if you use the price of your shares, or you index your price of shares in lieu of your goods or services, or in exchange of your goods or services, that is known as your cash settled. Later, we need to learn how to account for this equity settled or cash settled. So what is the scope of PFRS2? The concept of share-based payments is broader than employee share options. So PFRS2 encompasses the issuance of shares, the rights to shares in return for goods and services. So generally, we have here your share appreciation rights, employee share purchase plans, employee share ownership plans, and share options plans. But throughout the accounting for your share-based payments, what is normally used is your share option plans for your equity settled, and share appreciation rights for your cash settled. Okay? So the scope mainly is broader. It is not only your share options or the payment through a share, but it also talks about this different items. But throughout your share-based payments, or in whatever discussions that normally authors provide, they talk about your cash settled as share appreciation rights, and your equity settled as your share option plans. Rarely do they discuss these two types. So our main focus is your share appreciation rights and share option plan. So how do we classify your share-based payments? So under PFRS2, if we issue our own shares, it is known as equity settled. If it is cash or other assets, it is cash settled. And if it's choice between cash or equity, it is equity or cash settled. So you already know that if it is equity settled, it means that the entity issues equity instruments in consideration for services received, such as your stock options, as we have said a while back. For cash settled, we have here your entity incurs a liability for the services received or goods that had been received. So the liability here is based on the entity's equity instruments. We call normally your as cash settled as your share appreciation rights, and your equity settled as stock options. Remember, here you receive goods or services, you pay equity instrument. Here you receive goods or services, but you will pay a liability based on the price of your equity instruments. Okay, so it is indexed on your equity instruments. That's why it's called share appreciation rights. It is based on the appreciation or depreciation or the changes on the value of your equity instruments. While in your stock options, whatever is the value of your stock options. Now, if there is a choice between cash or equity settled, what we do here is to determine if ever we have your equity or we will settle it equity or we will settle it through cash. So how do we recognize your share-based payments? We know that there are two stock option plans that is equity settled and share appreciation rights that is cash settled. Now, your recognition depends if ever there is a vesting condition or without vesting condition. So what is a vesting condition? It is a condition precedent, meaning you need to meet that particular condition before you have the right over those share-based payments. So for example, if under your share-based payment, it provides for a condition that you must reach a 85% quota, then you must reach first 85% quota so that you have the right over that particular share-based payment. That's how your share-based payments work. So when we talk about your vesting conditions, generally your vesting conditions can either be a service condition or a performance condition. So what is the difference between these two vesting conditions? Actually, they are still conditions in which you need to meet. But we try to look what type of condition is provided in that particular share-based payment so that we know whether what type of vesting condition should we particularly meet. So for example, if ever the vesting condition or condition provides for remaining in employment after 3 years, that is considered service condition because you need to serve for 3 years. If ever it is based on a let's say growth in profit or earnings per share, we call that performance condition. So uh, here in your vesting conditions, you do not actually determine if ever what type of condition. It is not important for your accounting purposes, but in case it is asked for your theoretical purposes, at least you know what is the difference between a service and a performance condition. Normally, a service condition is remaining in employ, while your performance condition can either be a market or non-market condition. For your market condition, this can be increase on your share price. Non-market condition, we have your increase in profit, etc. Okay. So what is important here is for you to know whether there is a vesting or non-vesting condition. So if any of these items are present as to your giving or providing of your share-based payments, then we say it has a vesting condition. So if it has a vesting condition, you recognize over the vesting period. So what is the vesting period? Normally, this is your number of years or number of months, depending on the problem. If it is without vesting condition, you will recognize in full. Here in your vesting condition, let's say for the total amount of 900,000, you will recognize it over the vesting period. So for example, we have a 3-year vesting period. If our total value is 900,000, you recognize it over the 3-year vesting period, 300, 300, 300. That's how your with vesting condition works. But if that is without vesting conditions, you will recognize it in full. So if the value is 900,000, we will recognize 900,000 in full. So in short, in your vesting conditions, it's as if we defer it over the period of the conditions. The deferral of the period of your conditions depending on what is provided as a vesting condition, whether that is a service condition or a performance condition, so long as there is a conditional period for you to meet so that at least the right over the share-based payment will accrue. Next, if there is no evidence of vesting condition, we treat it as without vesting condition. Therefore, we recognize it in full. So what you need to know here, after determining whether it is equity settled or cash settled, so it is equity settled if you see share options. If you see share appreciations, it is cash settled. What's next is you to determine whether it is with vesting or without vesting. If with vesting, over the vesting period. If without vesting, you need to recognize them in full. So since you already know how to recognize a particular share-based payment, whether that is equity or cash settled, we look now as to the measurement if it is equity or cash settled. Okay, remember, equity settled, share options. Cash settled, that is share appreciation. So for your measurement, transactions with non-employee or transactions with employee, it is based on your fair value of your equity instruments. If it is with non-employee, fair value of goods or services. Next is fair value of equity instruments. If with employee, always at fair value at equity instruments. This is only measured at grant date. Measured at grant date. Never re-measured. It is never remeasured. Always at grant date. So whatever is the fair value at grant date, that will remain the same. However, in cash settled, whether it is transaction with non-employee or transaction with employee, it is measured at fair value of liability at grant date and every reporting period. So in short, it is remeasured every reporting period. Here, it will remain stagnant at fair value. So normally, you will look at it as this way. So number of stocks multiplied by your fair value, this will remain the same. Okay, this will remain the same in your equity settled. In your cash settled, the fair value changes. So every year, let's say year one, year two, year three, every year this fair value change. So let's say 28, 30, 25. Ganun yung pag-measure natin. Dito, kung at grand date it is 28, laging 28 yan. Kahit pa magbabago yung fair value at the end. Because for equity settled, we will only measure it at grand date. For cash settled, we measure it at grand date and remeasure it every reporting period. Clear? Okay. So we look now into our main rules in your share-based payments. So under PFRS2, what you need to look is whether there is a equity settled or cash settled transaction. Equity settled if that is share options, cash settled if that is share appreciation rights. So how do you measure it? It depends if ever there is a vesting condition or no vesting condition. Vesting condition over the periods of vesting, non-vesting condition, if there is no vesting, you will recognize in full. So the question is, how do you measure it? For equity settled, it is fixed based on the fair value at grant date, while your cash settled is measured based on the fair value at grant date and every reporting period. Fair value at grant date and every reporting period. So this one is remeasured, this one is not remeasured. So those are the rules that you need to take note in share-based payment. So again, what we do is we just need to get first the number of stocks. You multiply it into your fair value depending if it is equity or cash settled, and then we recognize it if it's vesting over the period of vesting conditions, if non-vesting, full. So, yun lang yung kailangan nyo alamin dyan. Let's try to solve some problems. So, first example. So, this is equity settled. So Irish company issues 4,500 shares to its external lawyers for services related to the successful completion of a lawsuit that Irish company is currently defending. The lawyers spent 300 hours working on the case. On the basis of recent invoices from the lawyers, Iris determines the fair value at 900 per hour. The quoted price of the shares was 58. So this is equity settled without vesting condition because as you can see, there is no condition provided in the problem. But what we need to take a look here is how do we measure it? So how to measure it? We measure it based if ever it is transaction with employee or with non-employee. As you can see here, It is external lawyer. So this is a transaction non-employee. If it's transaction non-employee, we measure it first on the fair value of goods or services. Next, we measure it based on fair value of equity instruments. What is the fair value of goods or services? 900 per hour times 300 hours. 900 per hour times 300 hours. So this will give us 270,000. How about equity instruments? 4,500 shares multiplied by 58 per share, we have 261,000. So how do we measure that again? Since this is a transaction non-employee, we measure it based on fair value of goods or services, 270,000. Ang sagot dito ay 270. Okay, so this is an example of an equity settled without vesting condition transaction with non-employee. Okay, balikan natin. Transaction with non-employee, fair value of goods or services, fair value of equity instruments. So here we have external lawyer. It is with non-employee. So get the fair value of goods or services. That is 900 per hour times 300 hours. Another example, Caitlin Company hired Snow, an external consultant, to assess its oil reserves. The service was provided over a 5-month period and will be settled by Caitlin issuing 100 of its shares Snow to the value of 40,000 at issuance. Caitlin estimated the cash fair value of the consultant was considered an employee for tax purposes. So it is considered an employee. So you just need to get for the fair value. So this is equity settled. There is non-vesting condition, and it is a transaction with employee. For employee, you get the fair value of the equity. So what is the fair value of equity? We only have one value here, that is 40,000. So your answer should have been 40,000 pesos. Okay, so it is an employee. So get the fair value, 40,000 pesos. Clear? Okay, we go back. So equity settled without vesting conditions or considered as non-vesting. How do we recognize them? In full. So if it is transaction with non-employee, how do we measure it again? At fair value of goods or services. That's the first. And the second one is at fair value of the shares. If it is the transaction with employee, always measure it at fair value of shares. Clear? I hope so. Next example. So this is already an example of a share wherein share-based payments wherein there is a vesting condition. So it's still equity settled with vesting conditions. So on January 1, 2016, Eddie Company grants 90 share options to each of its 100 employees. Each grant is conditional upon the employee to work for Eddie Company over the next 3 years. So this is the vesting condition. You need to work for the next 3 years. What do we call this one? Service condition. So ID company estimates that the fair value of each share option is 18 pesos. So this will remain as the value of our share option. So to compute, as we have said, we have your number of shares multiplied by the persons entitled. So this is the total shares multiplied by the fair value. So since they have 3 years here, year one, year two, and year three, our fair value of shares will remain the same, 18 pesos each year. Next, the weighted probability is that 20% of the employees will leave during the 3-year period. So let's compute. For year one, the number of shares is 90 share options. So it's 100 employees. However, 20% will leave. So our first estimate is 100 less 20%. So we have here 80. So 90 times 80, 90 times 80, the number of shares is 7,200 multiplied by the fair value. 129,600. Next, for year two, in 2017, 13 employees left, and the company revises its total employee departures. Take note, total employee. So if that is already considered total, we need to deduct the 25% as a whole. So 100 less 25%, so we have here 75%. And then for year three, what is the actual number of employees that left? 9, 13, and 8. 9 plus 13 plus 8. So we have 30 employees. So 100 less 30, so we have 70. So 90 times 75, we have 6,750 times 18, 121,500. Then year 3, we have 90 times 70, 63 times 18, we have 113,400. So this is the total expense multiplied by your vesting period. So this is year one. So one period, year two, two periods, year three, three periods. So 1/3, 2/3, 3/3. So amount, total amount to be recognized. So first you have 129,600 times 1/3. This is 43,200. 121,500 times 2/3. So we have here 81,000. And then 3/3, we have 113,400. Less previous year value. So no previous year. Here we have a previous year value, 43,200. Here, 81,000. Compensation expense. So this total amount presents the balance of share options. Total amount presents the balance of share options. The last amount here presents the amount of compensation expense for the year. So how much here? 43,200. Here, 81,000 less 43,200, 37,800. Then we have 113,400 less 81,000. We have 32,400. Okay. So we are ready to answer. So as you can see, we just need to get first for the total shares. That is equal to your number of shares times the employees entitled. We multiply it to your fair value. As you can see, guys, we only use one particular fair value, that is 18. Because we said if that is equity settled, we will remain as to the fair value at the grant date. So the fair value of your grant date is 18, so we'll still make use of 18. And then we multiply it to your vesting period based on your vesting conditions. So our vesting condition is that 3 years, right? So 1 period, 2 periods, 3 periods, 1, 2, 3 over 3, 1, 3, 2, 3, 3, 3. And then we get the amount. The amount there is the balance of your share options. So 43,200, 81, and 113,400. We use the previous year amount, 43,200, and then 81,000 to get for your compensation expense, 43, 37,8, and 32,400. So let's try to answer now the problem. So the first question is, how much is the compensation expense for 2016? So that is year one, 43,200. Next question, what is the premium on stock option outstanding on December 31, 2017? I said the amount, that is the share options. So year one is 2016, year two is 2017, year three is 2018. So 2017, we have here equal to 81,000. The balance of share options outstanding, 81,000. Next, the reduction to income in profit or loss section for 2018. So this talks about your expense for 2018. So what is the amount of our expense for 2018? 32,400. And the net effect to Edis company's stockholders' equity for 2018, none. Your answer here is zero. Why? Because you will recognize compensation expense, right? So this will decrease your retained earnings. But you will recognize share options. This will increase your equity. So decrease, increase of the same amount, no effect. Okay? So your answer here is zero because it does not have any effect. Okay? So I hope we are clear as to the computation of this particular type of share-based transaction. Take note the amount represents the balance of share options, and the last is the compensation expense for the year. Okay? And the last one, our answer is zero. Sir, why zero? Because here, you, as I told you, the compensation expense 32,400. So you will entry it compensation expense 32,400, and then share options outstanding 32,400. Compensation expense will decrease RE, therefore decreasing shareholders' equity. Share options outstanding will increase APIC, therefore will increase shareholders' equity. The same amount of increase or decrease will have no effect. The same amount of increase or decrease will have no effect. So that's how we compute for your equity settled with vesting conditions. We look into the amount of entitlement each year. Okay, another example, this is with vesting conditions, equity settled. So Wally Company issued 100 share options provided that these employees will remain at year end, revenues 1 million, and the share price will exceed 50. The share options will expire in 10 years and the fair value is 25. If all of the employees remained at year end, so we have three, right? Remain at year end, revenue is more than or at least 1 million, greater than or equal to 1 million. And then the share price should be more than 50. Employees remained, yes. Revenues 1, 2, that is more than or equal to 1 million. Share price was 51, yes. So all vesting conditions met. Since all vesting conditions met, we have an expense. So 25 multiplied by 100, so this is 25. Next. If all employees remained employed at year end, so year end, check. Revenues should be greater than or equal to 1 million. It is 900,000 zero. So not met. Our answer here is zero. Why? Because again, we did not meet our vesting conditions. So we will not provide anything at all. Next condition. Remember we said the vesting conditions tells you whenever the employee will or whenever a person will receive the share-based payment or not. So if the vesting condition is met, of course, there is a share-based payment. If the vesting condition is not met, then no share-based payment. Let me see. If all employees remained employed at year end, revenues is more than or equal to 1.2 million, and the company share price should be greater than 50. So this is not met because the share price was 45. Again, zero. Here, if 90% of the employees remained employed at year end, so still employed, revenues amounted to 1.2 million. So this is greater or equal to 1 million. So, okay. And then share price must be more than 50. This is 51. Okay. So how much then? So if we have 25 and 90% only is the remaining number of employees. So 25 times 90%, we have 2,250. So our answer, first answer is 25, 0, 0, and 2,250 based on the vesting conditions. Okay, so here this vesting period is only 1 year. As you can see, based on the vesting conditions, we look if ever those conditions were met or not, so that we say we have a share-based payment. Okay. Another example, Oliver Company grants 1,000 share options to each member of its sales team, 20 in total, conditional upon the employee's continued employment for the next 3-year period. Okay, Arrow, units of product Arrow over the 3-year period. Okay, by the end of 2018, sales of product. In 2017, Oliver increases the sales target to 1 million. So initially, it is only 600,000 units, and that is the vesting condition. So if there are changes in your conditions, how do we account for it? Generally, we ignore those changes in your conditions because we look as to your grant date as to the condition. Any subsequent conditions should apply prospectively, not retrospectively. So let's compute for your compensation expense. So we have 1,000 share options. So number of employees entitled. Wala namang umalis, di ba? So what is the total shares? 20,000 multiplied to the fair value, 15. So this is 2016, 2017, and 2018. So the number of employees remain the same, 20. Wala namang umalis. So 1,000, 1,000. So the total amount, 20 times 15. So we have 300,000. Multiplied by the vesting period, 1, 3, 2, 3, and 3, 3. Total amount. This is the share options outstanding, 100, 200, and 300. Less the previous year, 0, 100, 200. Compensation expense, 100, 100, 100. Okay. So what is the compensation expense for 2016, 2017, 2018? Our answer is 100,000, 100,000, 100,000. You should ignore the change as to the sales target because again, what is the vesting condition? The vesting condition is only 600,000 units. So the increase is immaterial to your initial vesting condition. So your answer here is 100,000, 100,000, 100,000. Okay. So equity settled, we talk about your share options, transactions with non-employee or with employee. With non-employee, fair value of goods or services, and if none, fair value of shares. With non-employee, only fair value of shares. Take note, you measure this one at grant date. If there is a vesting period, you will recognize it over the vesting period. If there is no vesting period based on a vesting condition, you recognize them in full. Those are the rules on. Last topic, we have your share appreciation rights. For your share appreciation rights, we said we will recognize them based on a cash settled transaction. And that cash settled transaction, again, with whether it is with non-employee or with employee, we measure it at the fair value of the shares at grant date and at every reporting period. Okay. So on January 1, 2015, Felicity Company grants 100 cash share appreciation rights to each of its 400 employees on the condition that the employees remain in its employ for the next 3 years. During the year 15 employees left the firm of Felicity. Felicity estimates around 45 employees will leave over the next 2 years. In 2016, 20 employees left the firm, and Felicity Company expect that 20 employees will leave by next year. At the end of 2017, 15 employees left and 120 employees exercised their share appreciation rights. In 2018, another 125 employees exercised their share appreciation rights. At the end of 2019, all the remaining 105 employees exercised their share appreciation rights. Okay, so in your share appreciation rights, generally, what we account here is first the value of your share appreciation, and then in case there is share appreciation, we need to deduct them into the amount of your compensation expense. So how do we compute for your share appreciation? The share appreciation happens whenever there is already a vesting condition met. So here, 3 years, that is 28, 26, 32, 28, 31, 31. So we have here difference of 2. Here we have a difference of 4. Okay, so let's account for it. What changes here only is that you will measure it based on the fair value of the share appreciation every year end. So we have 2016, 2015, 2016, 2017, 2018, and 2019. First, we have your share appreciation. So number of shares, so 100, 100, 100, 100, 100. Number of employees. So for 2015, our number of employees is first we have 400, right, initially, and then we have 15 employees who left, and then 45 which is expected to leave. So this is 60 employees. For 2016, we have 400, and then we have 15 initially who left, and then 20 who additionally left the company, and 20 who will leave the company. 400 less 15 less 20 less 20. This is 400 less 60 is 340. So this one is 345. 2017, 15 employees left. So 400 less 15 less 20, 15, 20, and then additional 15. So we have here 350. In 2018, we have 350 and we have 120 who exercised their share appreciation last year. So we have only 230. In 2019, we have here 230 less 125 who left on 2018. So we have 105. Is that right? 230 less, yes, 105. So after we compute the number of employees, we get for your total amount of shares. So 100 times 340, 34,000. This one is 34,500, 35,000, 23,000, 10,500. Multiplied by the amount of your fair value. So the fair value is 22, 26, 28, 32, 31. As you can see, we use your different fair values. We did not use a fixed amount of your fair values. So this is the total amount, 34,000 times 22. We have 748,000. 500 times 26, 897,000. 35,000 times 28, we have 980,000. And then we have 23,000 times 32, 736,000. Then 10,500 times 31, we have 325,500. Multiplied by your vesting period. So 3 years lang, no? 1, 2, 3. So by end of 2017, it is fully vested. So for 2015, 748,000 times 1 over 3, we have 249,333.33. 897,000 times 2 over 3, we have 598,000. So this is 980,000. This is 23,000 times 32,000, 736,000. This is 325,500. Less the change as to your market value, less intrinsic value, and any settlement. Okay. So the change in your values happened in 2017. So it is 2 multiplied by the uh, number of our shares that is settled. So how many shares were settled? 120, tama? 2 times 120 times 100. And then for 2018, how many shares were settled? We have 125 shares, tama? So 4 times 125 times 100. Market value less intrinsic value multiplied by the shares settled. So our shares settled for 2017 is 120. For 2018, 125. Okay, so 125 employees times 100 shares, cash shares, 120 times 100 cash shares. Kaya ganun siya. So this is 24,000 and then this is 50,000. So dito wala because it is 31 and 31. Let's the settlement. So to compute for our settlement, it is equal to the value of our shares settled. So our shares settled is 120 times 100 times the value of 28. 120 employees who left on 2017 times the fair value of 28 multiplied by the 100 shares settled. So this is 336,000. So this is now the amount of our compensation expense and the balance. So 249,333.33, 598,000. We have 480 less 24,000, 980 pala. 980 less 24,000 less 336,000. We have 620,000. Mamaya na. Dito muna tayo sa compensation para hindi kayo malito. We first compute for your compensation expense. So our compensation expense for 2015 until 2019, we have 249,333. We have yun na lang muna computein natin, yung ating compensation expense. And then we have your settlement. Na-compute na yung settlement natin kanina, no? Our settlement a while back was computed as 24,000, I think, and 50,000. Okay, so we have here 249,333 for 2016 and 2015, 249,333.33. 598,000 less 249,333.33. We have 348,666.67. For 2017, we have 980,000 less 598,000 less 24,000 settlement on the change as to your intrinsic and your market value. So we have here 358,000. So 358. Next, we have 736,000 less the settled of 336 less 358,000. We have 42,000. And then how much is our last settled? Our last settled amount is 125 employees. Six, 125 employees. Okay. So we have 125 employees who left at the end. We first compute our salaries payable at the end of each year. So 2015, magkano na yun? 249,333.33. 2016, we have 598,000. In 2017, we have 980,000 less 336,000, which has been settled. 644,000. And then we have 2018. 32 times 125. How much is our balance? 736 less 32 times 125 employees times 100. 736 less 400,000 is 336,000. And then 2019, we have 325,500, the value, which is based on 31. And since we have 31 value, 105 employees left, so this will be 0. That's our amount of our salaries payable. So our salaries expense, we have already computed it, 249,333, 348,166.67. And from your 980,000 less 598, we have 382 less 24,000, we have 358,000. So from 358,000, we deduct your from 736,000, we deduct 336,000, which has been paid. And then we need to deduct the previous year until we get your 42,000. And for the last one, we have 325,500. Based on this value, we get for the difference as to the amount of the remaining balance last year, 400 less 50, 350. So we have here 10,500. Oh. So here, guys, what we did was to get for the fair value. Remember this one. Ito lang naman yung kailangan ninyo, yung fair value. Pagka nakuha nyo na yung fair value, you multiply it to your vesting period. Pasensya na, medyo magulo yung solution natin. Kunin yung vesting period, and then yung vesting period niya, yun yung amount ng ating compensation expense. Alam nyo naman na yung mangyayari dyan. Ibabawas natin. Pero dito, kailangan mo magbawas ng settlement amount, which is 24,000. 100,000 pesos for this particular example. And then we also look after that the balance. So 736,000, that is our previous year balance. Less 900, 736 less 336,400,000 less 358, which is the previous balance. We have 42,000. And then 736 less 336, we have 400,000 less 358 for the previous year. We have 42,000. 736. Tapos ito 336. Tapos yan ay 400,000 less the previous year 358. So 42,000. Okay? That's our share appreciation rights. I think there was a problem here which was already raised by your classmates. The problem here was that I was not able to provide this 15 employees left. I wasn't able to provide this 15 employees left. That's why at the end, hindi kayo nag-equal sa 105 kasi nga kulang ng 15 employees left. Probably I'll just check until 2018. Hindi. At the end, oh yeah, till 2017 lang. Because magkakamali na kayo by the end of 2018 because you will not get the same amount due to the 105 employees na hindi mag-equal dun sa ending na 120 because of the 15 employees na nawawala.